Hello everyone. Thank you guys for tuning in into another beautiful educational content about trading. All right, without wasting any of your time, let's get straight into it. So when most people start trading supply and demand or trading generally, okay, it's a general concept. We are often looking for catching reversals, which is not wrong, which is not bad. I have strategies that talked about that. If you look at my playlist, okay, my kind of concept is more like I'm building upon one particular strategy. So looking back at my videos, I'm not just giving you different strategies, it's just one strategy, but I'm building upon it so you can get better at what you do. Okay, so let's say in the beginning you want to trade like this. You see this kind of consolidation, something like this, yeah, and then you see another strong aggressive push to the downward side, okay, that took out the previous low. So which means that is like a break of structure, and then we have maybe a pullback like this, and then to the downward side again. All right, so beautiful. So something like this. So you mark out this particular point as your supply zone. Okay, you mark out this particular point as your supply zone, something like this. And now you're anticipating for price to like come back to this region so you can take your reversal. It's basically that is it. So your setups is going to be something like this. Setup is going to be something like this. Entry probably at this supply zone, stop loss slightly above it, and then you want to go down like this for your take profit, probably to that demand zone or whatever. Okay, this is the basic concept of how almost everybody starts trading. Everybody trades like this, and this is not a bad thing. However, the issue with this is that you will be having less setups, and I get it, they'll tell you less is more, wait for your A plus setup and all of that. Now an A plus setup doesn't necessarily need to take you about what, 1 week before you see a trade. Okay, because the truth is every day is not a reversal day. So now you're telling me, until do you think price will just, look at the chart, do you think price will just, as it gets back here, and then price is just going to go straight to your supply zone and then you take the trade? You could wait for 1 week. You could wait for 1 week hoping for this setup, and the funniest thing is it can get there and still not respect your setup. So which means you have successfully waited for 1 week before hitting a loss. Not saying it's bad, patience is key. All right, because the truth is this is how price will go. But let's delete this. Let's delete this here. All right, so this is like, what is this, a break of structure? You have another break of structure here. Let's mark this. So you have a break of structure like this, and then you had another break of structure after the second pullback. Good. So break of structure here, a break of structure here, pullback. So now most cases this place might have a fair value gap. Most cases, all right, if the jump was aggressive, this point might have a fair value gap. You should be familiar with something like this. Let's make it white if you do trade supply and demand, SMCs. So this point has a fair value gap, which was the aggressive move. So this is the actual supply zone you are looking off to trade, the reversal. And now price gets here, probably there was a demand zone at this previous zone, which now makes price hold at this point. Okay, we are getting to the main lesson, which is trend continuation. So now price gets here and hold. So we have a newly formed demand zone at this point like this. We have a newly formed demand zone at this point like this. So which means after price dips to this point, we start seeing that kind of push up, okay, then downward push, then we had another upward push that took out the previous high, right? And then we go like this and we keep going like this. we keep going like this, and that's how we keep going, breaking structure to the upward side. All right, we keep forming higher highs, higher highs, higher highs, okay, higher highs and higher lows like this until we get to this supply region, which can then react to come down. And in order for it to come down to this point, which was the initial demand zone, all right, that means there needs to be a strong selling force. So SMC traders, supply and demand traders like you and me are looking forward to catching that reversal so we can short it from here and then sell it back to this demand zone. All right, now let's look at some things, some beautiful things that happened here. We had the first break of structure. Okay, we had another break of structure here. We had another break of structure here. All right, permit me if the lines are not straight. I'm using this to create an illustration which is very familiar to you guys on the chart, so you get to understand how you can take trend continuations. So we have another break of structure. So literally we had numerous break of structures, and this can take days. When I'm talking about this, I'm talking about on the 15 minutes or 30 minutes time frame, right? Which means we could have had that massive sell probably on Friday. Okay, the market really sold badly on Friday, and then Monday, Tuesday, Wednesday, Thursday, or Monday, Tuesday, Wednesday is all about the continuations to the upward side, so we can find a way to tap back into that supply zone. If the supply zone is strong enough, we have a reaction to the downward side. If it's not, okay, we'll have a reaction but not all the way down to this demand zone, and then we're going to break that supply zone to keep forming new higher highs. All right, that is beautiful, easy concept, understood to this very point, right? So now what you want to understand about this thing is liquidity. Okay, if you want to trade anything in the market, you need to understand where liquidity lies. So now the thing is that these points here, this last area of demand where price dipped to, becomes an area of liquidity. So SMC traders will be looking forward to taking out that liquidity. Okay, so let me use this and then type in the $sign just to show liquidity. Okay, beautiful. Now this is the first leg of liquidity, or this is even the strongest. Now we'll have another area of, so okay, good, let's spend this here first, we'll come back to it. Now in the process of the market going up back to this supply zone that was created, we are forming new demand zones. This is the first demand zone that was created. This is another demand zone that was created. Okay, this is another demand zone, beautiful demand zone here like this. Good, we have another demand zone here. Like this, another demand zone, and it keeps going on and on and on like this. This is another demand zone. Okay, like this. Now stay with me so you get every single point along. So we had multiple demand zones piling up, which means people, obviously when you see a chart like this, the market is in an uptrend. It's going higher and higher, and then people keep buying. So the more they are buying, the more price is pushing upwards, right? Beautiful. And then we have a strong area of supply in which price is supposed to react from and then come down. Okay, this is another demand zone here, like this. Okay, then the last demand zone here, like this. So in this case right here, once price gets to the supply zone that we are looking at, all right, this supply zone here, and then it reacts and take out this supply zone here, that is when we now have a structure shift. which is also known as a change of character. So now that indicates that we are no longer bullish and we are changing structure to the downward side, which can often indicate as a confirmation. So then we'll have this place, okay, those that wait for confirmation, if you didn't just set your limit at this point, those that wait for confirmation will now set their supply zone like this, entry at the change of character line like this. Okay, you don't need to, like, you don't expect price to go above this new fractal high that was formed here, and so this is their new area of supply like this, and then they want to go short like this. So entry at the change of character line, I believe everyone is following up to this point. Entry at the change of character line like this, stop loss at the fractal high that was formed inside that supply zone, and then we have the take profits probably at this liquidity level. This is it. This is how you've been trading. This is how I've been trading. This is how I still trade. Okay, so now let's clear this off and see something probably you never really thought about. Okay, something that you didn't think about, or you might have thought about it but didn't know how to go about it, and that is why you're in this video. So now when you see the market in an upward trend like this, don't you think it is nice for you to enter a long and just ride it? Now, not riding it with an unrealistic expectation of to the moon, being self-conscious of where your supply zone is. So all you need to do is just the trend line traders will say this is a trend line, something like this. I don't trade trend line, okay, but they'll say this is a trend line, this is trend line, something like this. So yeah, so they're like, oh. So now what I'm trying to institute in this situation is, why don't you just enter here? Let's say you missed this move, or you know about reversals, but you should be able to trade trend continuation, which means on Friday that this was a sharp fall, on Monday they are breaking structures to the upward side. You could capitalize on that rather than waiting until you get to this point. So probably you take only one trade for the week, and what if that supply zone didn't hold? Then you end up losing for the week after waiting a very long time, especially if you are trying to pass prop firm challenges. If you are trying to pass prop firm challenges, if you are waiting for too long to see a setup, or generally, okay, when you see your friends, they are taking setups, they are catching massive moves, and you've been like, oh, no trade today, no trade tomorrow, no trade next tomorrow. You've been waiting for 4 or 5 days, no trade, because the market is just breaking structures to the upward side or breaking structures to the downward side. It might make you start taking trades you're not supposed to take. Okay, enough of the explanation. I believe this is very, very explanatory enough. Now, how do you take a trend continuation? So this is it. We had our demand zone here. I'm going to extend this like this for proper explanation, so I don't tamper with this. So now the first thing is, price came into this point, all right, and then went up a bit, pulled back, okay, and then we had a break of structure, okay, which means this is our original demand zone. This becomes an inducement, an area of fake demand. This is an inducement here, where most people who had entered long in the wrong place will place their stop loss. Okay, there is this trader, I don't know his name, that says you want to place your entry at where most people will place their stop losses at, and see how often, okay, the market is going to move in your direction. So this becomes an area of inducement. This becomes a break of structure here. When you see this, okay, when you see this, you already know that, okay, the market is now in an uptrend. We've stopped coming down, we are going up. Now let's say all of this is happening on the 30 minutes time frame or 15 minutes time frame. It's too big if you want to start entering at demand zones of 30 minutes time frame or demand zones of whatever, 1 hour, 15 minutes. So I personally recommend going into the 1 minute or the 3 minutes time frame. Now you are not using the 1 minute or the 3 minutes to analyze the whole market structure. Don't get it twisted. You are just using it for your entries. You know where your supply zone is located at your 30 minutes or your 15 minutes time frame. Okay, the 1 minute or the 3 minutes is just to help you get a good and precise entry with lesser risk. Your stop loss is not as wide as a GP tank, right? So on the 1 minute time frame now, let's clear this and say you've seen this on your 30 minutes time frame or you've seen this on your 15 minutes time frame. That's a confirmation, all right, that okay, we are now in an uptrend. Or you could also use change of character, right? When price goes down and then we have this push up and then breaking structures to the upward side, or change of character, either ways. Okay, that's not the explanation. So now you've confirmed that the market is now shifting to the upward trend. You go to the 1 minute time frame, you're going to see things like this. You're going to be seeing numerous break of structures to the upward side. Okay, numerous ones like this, come down like this, take out that previous high. Yeah, something like this, take out that previous high, come down again like this, and then take out the next high. Beautiful. This is what we are looking for. Exactly this. You want to look for two break of structures in the same direction, which is also in line with your bias, which means you are looking for longs, right? You are looking for longs at this point. You are looking for longs. So you've confirmed on your higher time frame that the market is in an uptrend. So now what you want to do is you want to make sure that you are looking for only longs. If the 1 minute or the 3 minutes time frame is doing break of structures to the downward side, you are less concerned with that because you know the direction, you know the overall direction of the market from the higher time frame. So we are looking for two consecutive break of structures in line with our direction. So we're looking for longs as at this. So now I go to 1 minute time frame or 3 minutes time frame and I see, you just have to stare at the chart. You have to stare at the chart at that point, all right? Probably it's in your trading session like London session or New York session. If you trade Asian session, all well and good, the same thing, it works in every session. All right, so you're looking for two break of structures in line with the direction that the overall market structure is. So we have this like this now. So this now becomes a liquidity area, a very strong liquidity area on the 1 minute time frame, which price is not supposed to go back to. Okay, this is your first leg of liquidity. Now this is a demand area. This becomes a demand area. Okay, like this. This becomes a demand area. And then this becomes an inducement. It's also a demand area, but we have liquidity resting at this point. So liquidity is resting here. And this is also another demand area. So liquidities will always be resting at the lows of a particular move. So this is demand area 1, demand area 2, which was formed through two different break of structures. All right, perfect. Now some people use Fibonacci to like look, okay, we have multiple demand zones, which is very normal. Which demand zone should we trade off with? You don't know. Okay, so in this situation, it's very, very easy. All you have to do is just take your long position like this when you see something like this, and then, oh, what's wrong with my Wi-Fi? All right, good, it's back online. So you want to set your stop loss at the main liquidity area like this. Now, where do you set your entry? Okay, market structure traders, or those that trade market structure and liquidity, will tell you, set your entry here like this, and then yes, and then allow market to take out liquidity. So you get tapped in at this demand zone and you can target a new higher high, or you can even target your whole, the whole move and sell it off back to the supply zone here, which you anticipate price to react from. Okay, so in this kind of case, right, in this kind of case, you've missed the original demand zone, which was on the 30 minutes time frame, and then price is just in an uptrend. You want to look for how you can continue. You come to your 1 minute or 3 minutes time frame, you look for two break of structures in line with your main bias, which we have here. We had the first demand, we had the second demand. The second demand is an inducement. Okay, price is going to come back down here, take out this liquidity, because most people's stop losses are going to be here. Take out this liquidity to push higher again, and then this point, once this high gets taken out, it becomes what? It becomes another third break of structure, right? So now the thing with setting your limit order here, especially on the lower time frame like the 1 minute or the 3 minutes, is spreads. Your broker might not tap you in because it might just come very little into this point and then it reverses on you. So which means you were right, you did your whole analysis, you spent hours on the chart, and yet only for you to miss the trade. So better still, set your entry at the liquidity. So that's now where we take the concept of that man who said you want to set your entry at where the masses will set their stop loss. Okay, some people are already long on this position, so they are trailing their stop loss. Those that enter late, okay, their stop loss is here. Right now, what the market is going to do is the market is going to come down after two break of structures. It's going to come down like this to take out this liquidity and hit this original demand zone to then continue higher. All right, to then continue higher, which will now become a break of structure again, which will now become the third break of structure again, like this. Okay, this now becomes the third break of structure. So which means price came here, gave a change of character. Okay, we were in uptrend on the 1 minute time frame or 3 minutes time frame. So this becomes your change of character like this. On this line becomes your change of character, which is a fake change of character, because on the higher time frame we are overall bullish. Okay, but anyone that doesn't understand the higher time frame analysis would think, oh, because we've gone up like this, now we're in a downtrend. So this is a change of character to the downward side, only for it to tap this strong demand zone after taking out this liquidity. So now you are in the trade, and then it goes up back after stopping a lot of people out and then breaking structure, and we keep going like that, like that, like that. So it's very, very crucial for you to understand where to place your stop loss. You want to place your stop loss at this initial liquidity. Now at this initial liquidity, we know price is not supposed to break through this, because if it breaks through this, now we are breaking structure to the downward side, which is highly unlikely. Okay, which is highly unlikely to happen, and we have it. So that's how you take a trade continuation. So that way, on Monday or Tuesday, you could have taken a trend continuation trade. Thursday or Friday, when it gets to the reversal point, you also take reversals. So that way, you are taking more trades with still good analysis. Okay, not like you're taking more trades for the sake of taking more trades, but you're taking more trades, okay, with still good analysis of supply and demand. Thereby, you're making more money for yourself, and everything goes well for you. So if this video was of any value to you, of any help to you, the only thing you can do for me is by showing me some form of appreciation. Okay, hit that like button, hit that subscribe button, drop a comment on what you think about this video. If there is any addition, subtraction, or whatever it is you feel, let me know. Okay, and if you think there is another video idea in line with supply and demand, okay, that I haven't covered, or you want me to talk about in my next video, let me know, and I'll see you guys in the very next video. Peace out.